Hey everyone, Alex here. Let me tell you right now, what you are seeing on the news about Tesla ending custom orders for the Model S and Model X is a complete distraction. The headlines are calling it the end of an era for passenger electric vehicles, a nostalgic sunset for the cars that launched the EV revolution. But if you actually look at the underlying financial architecture, if you look at the real capital flows happening across Elon Musk's entire portfolio right now, killing the Model S is not some sentimental product decision. It is the first domino in a highly engineered $1.75 trillion liquidity trap, and almost nobody on Wall Street is talking about the actual mechanics of what is about to happen. Think about this from an engineering standpoint. In a manufacturing facility, floor space is the ultimate currency. Every square foot of the Fremont factory has an opportunity cost attached to it. For years, the Model S and X were the proof of concept. They were the high-margin, low-volume products that validated the entire tech stack. But over the last few quarters, if you pull apart Tesla's quarterly earnings and audit their balance sheet, like I do when evaluating a late-stage buyout, you see a terrifying compression in automotive gross margins. We are watching competitors slash prices in real time, completely destroying the profit margins that Tesla used to command effortlessly. But this is not just about Chinese rivals, like BYD pushing cheap metal. This is a deliberate, calculated pivot. Elon is clearing the floor space, completely burning the boats, to make room for Optimus production lines. He is betting the entire farm, the entire manufacturing footprint, on humanoid robotics. But the robots are just the hardware shell. To understand the true scale of this operation, you have to zoom out and look at the SpaceX initial public offering that is quietly making its way through the SEC. We are talking about a proposed $75 billion raise. To put that into perspective, that is more than double the size of the Saudi Aramco IPO, which was the largest in human history. A capital raise of that magnitude creates a gravitational pull so massive that it physically alters the liquidity of the entire tech sector. But here is the thing that really keeps me up at night. This is not a standalone event. The sudden price hike of $15,000 on the remaining Model S inventory, the confidential filing for the SpaceX IPO, the integration of Zai, and the massive $25 billion terafab chip project with Intel, all of these are interlocking gears in a single massive sovereign industrial ecosystem. And you are about to see exactly how this machinery is designed to trap institutional capital, while outsourcing the risk to retail investors. Let's break down the underlying logic, starting with the actual unit economics of what it takes to survive in hardware. People think building cars is hard, but building an integrated compute ecosystem that spans from orbital data centers down to silicon wafers on Earth is a whole different level of capital intensity. Let me give you a reality check on the contrast between Silicon Valley PR hype and actual brutal unit economics. I see founders all the time pitching software as a service multiples for hardware companies, and 9 times out of 10, they get laughed out of the room. Hardware burns cash faster than you can print it. When you are managing a remote global development team versus expensive local talent, you quickly realize that your biggest constraint is not ideas. It is free cash flow. Tesla has historically funded its own expansion through automotive sales. But right now, the lifetime value of a standard car buyer is completely decoupling from the customer acquisition cost. In the early days, Tesla spent $0 on marketing. The customer acquisition cost was effectively zero because the product was a monopoly on the future. Today, the market is saturated. The marketing arbitrage that used to exist is gone, replaced by a vicious cycle of ad spend just to maintain market share against legacy automakers who are willing to take a loss on every EV they sell. So, if you are sitting in the CEO chair, staring at an Excel cash flow projection at 3 a.m., and you realize your core product's margin is eroding permanently, what do? You do not keep fighting a price war. You pivot to a completely new paradigm where you hold a monopoly again. That is exactly what the shift to Optimus and the terafab project represents. The terafab project is a 100 million square foot chip factory. Do you understand the sheer scale of that? It is designed to produce silicon logic memory and packaging entirely in-house. This solves the hidden scaling costs of tech infrastructure. Right now, every AI company in the world is getting absolutely crushed by insane Amazon Web Services, bills, and NVIDIA hardware bottlenecks. By partnering with Intel, Musk is attempting to vertically integrate the most expensive part of the AI supply chain. The plan is to build the D3 chips for SpaceX space-based data centers, and the logic chips for the Optimus robots right here on Earth. This brings us back to why the Model S had to die. You cannot maintain a complex custom order legacy automotive supply chain when your entire corporate nervous system is transitioning to mass-producing humanoid robots and autonomous cybercabs. The S and X lines were taking up cognitive bandwidth and physical space that needed to be allocated to the new compute era. But transitioning from a car company to an artificial intelligence and robotics conglomerate requires an unfathomable amount of liquid capital. You cannot fund a $1.75 trillion vision purely off the eroding margins of the Model Y. You need a massive injection of outside money, but you need it on your terms. Taking toxic institutional money is a death sentence for a visionary founder. I have seen lead investors pull their term sheets at the 11th hour just to force a founder into accepting brutal liquidation preferences and anti-dilution traps. Musk knows this game better than anyone. He knows that if he just went to Wall Street and asked for $75 billion to build robots and space servers, the institutional sharks would demand board seats, voting control, and aggressive downside protection. If this breakdown makes sense to you, hit that like button. It tells the algorithm to push this to more people who need to see the truth. So, how do you raise the largest pile of cash in the history of global finance without handing over the keys to the kingdom? You engineer a completely unprecedented IPO structure. You take SpaceX, a company that has captured the imagination of the entire planet, and you use it as the ultimate Trojan horse for the broader AI and robotics vision. Bloomberg reported that SpaceX filed confidentially with the SEC, aiming for a June listing. But the mechanics of this offering are what blew my mind when I started modeling out the capitalization table. They are reportedly aiming to allocate up to 30% of the shares to retail investors. Let's be real for a second. A 30% retail allocation for a $75 billion raise is not just unusual, it is practically illegal in the eyes of traditional Wall Street syndicate desks. Institutional investors expect to gorge themselves on the IPO allocation, pop the stock on day one, and leave retail holding the bag. But Musk is flipping the script, and this is where the $1.75 trillion liquidity trap snaps shut. I remember being in a Century City high-rise at 2 a.m., watching big law attorneys reviewing a 100-page mergers and acquisitions contract. The level of structural control a founder gives up in a traditional mega deal is absolute. The bankers dictate the terms, but Musk is bypassing the bankers' control mechanism by weaponizing retail liquidity. Think about the psychological reality of hitting financial freedom and why money loses its initial meaning. For Musk, it is no longer about personal wealth. It is about absolute control over the sovereign infrastructure of the future. He needs a shareholder base that acts like a religious movement, not a hedge fund algorithm. Retail investors are hodlers. They do not sell when the quarter misses by a penny. They do not demand stock buybacks to engineer earnings per share. I was reading through the sentiment on YouTube the other day, and you see this exact divide. You have the skeptics screaming that this is the same guy who promised full self-driving in 2019, and that this is a house of cards designed to dump on retail, and they have a valid point regarding the timeline slips. But then you look at the other side, people saying that Elon has made thousands of employee millionaires, and that lay is full of startups founded by SpaceX alumni. That second group, that massive base of true believers, is the exact liquidity moat he is building. When you allocate 30% of a $75 billion raised to retail, you are effectively locking up $22 billion in diamond hands. This creates an artificial scarcity in the float available to institutional short sellers. If a hedge fund tries to heavily short SpaceX, they will find themselves trapped because the retail base refuses to lend their shares or panic sell during a manufactured dip. It is the ultimate defensive architecture for a public company. But the trap has a second, much more aggressive mechanism. Sucking $75 billion out of the market in a single offering creates a massive liquidity vacuum. Let me walk you through exactly how this systemic shock plays out on the trading floor. Picture the Bloomberg terminal flashing red during a massive coordinated sell-off. That is exactly what happens to the broader tech sector when every major portfolio manager in the world suddenly has to rebalance their allocations to make room for SpaceX. If you are managing a $100 billion fund and the largest, most critical AI and space infrastructure company goes public, you have to own it. It is a career risk not to own it. To free up the billions of dollars needed to buy into the SpaceX IPO, these funds have to liquidate their holdings in other tech stocks. They will sell Microsoft, they will sell Apple, they will sell Google. This creates downward pressure on the rest of the market, effectively starving Musk's competitors of liquidity while he hoards it. As one heavily liked comment put it perfectly, a $75 billion raise will suck the liquidity out of the entire market for weeks. It is a strategic starvation tactic. And we have not even talked about the integration of ZI. Valuing SpaceX at $1.75 trillion based purely on rocket launch revenue is mathematically impossible. A 56 times price to revenue multiple for a heavy manufacturing and logistics company is absurd. But the narrative is shifting. The IPO pitch is not about launching satellites. It is about building the backbone of the new internet by merging the capabilities of ZI with SpaceX's Starlink network and backing it all with the silicon produced by the Terafab project. SpaceX ceases to be an aerospace company. It becomes a sovereign, vertically integrated data and compute monopoly. Let's trace the capital flow. The money raised from the retail and institutional buyers in the SpaceX IPO will be aggressively deployed into building out the orbital data centers and funding the Terafab factory. The Terafab factory produces the D3 chips for the satellites and the logic chips for Tesla S Optimus robots. Tesla, having cleared its factory floor of the legacy Model S and X, utilizes its massive manufacturing expertise to scale the physical robots. ZI provides the general artificial intelligence brain that runs on the Terafab silicon inside the Tesla manufactured robot, all connected globally via the SpaceX satellite network. Do you see the architecture now? It is a closed-loop system. The money never leaves the ecosystem. It is brilliantly terrifying. Every dollar of capital expenditure for one company becomes revenue for another company within the same walled garden. But what happens when a system this highly leveraged hits a macroscopic shock? I have seen the brutal dynamics of Chapter 11 bankruptcy and restructuring from the inside. When a heavily integrated supply chain fractures, the contagion spreads instantly. If the Terafab project faces significant delays, let's say due to supply chain bottlenecks hitting us ports down in Long Beach, the entire timeline for Optimus and the orbital data centers shifts. We are not just talking about missing a quarterly delivery target. We are talking about a cascade failure across 3 distinctly valued, heavily capitalized entities. Imagine the frantic PR team trying to draft a crisis response on a Friday evening, because the SEC just realized that intercompany transfer pricing between Tesla, ZI, and SpaceX is artificially inflating the revenue multiples of the upcoming IPO. The regulatory scrutiny on this level of integration is going to be microscopic. Navigating strict US regulatory compliance, dealing with the SEC, the FTC, the FDA is a nightmare for a single company. Managing it across a $1.75 trillion interwoven ecosystem is like trying to defuse a bomb while running a marathon. The risk of a single federal injunction freezing the operational capital of ZI could theoretically halt the deployment of Starship version 3, because the software development relies heavily on shared compute resources. When you step back and audit this entire sequence of events, from the quiet death of the Model S to the deafening roar of a $75 billion public offering, you realize that we are no longer operating under the traditional laws of corporate finance. We have entered an era where capital deployment is weaponized to establish sovereign technological states. The decision to discontinue custom orders for the Model S and X, slapping a $15,000 premium on the remaining inventory, is the clearest signal yet that the era of the electric vehicle as the primary growth driver is dead. The EV war is now a commoditized race to the bottom, fought on razor-thin margins against state-subsidized Chinese manufacturers. Musk is abandoning that battlefield entirely. He is leaving the scraps to the legacy automakers who are still trying to figure out how to build a profitable battery pack, while he moves the entire weight of his empire to the high ground of artificial general intelligence and humanoid labor. This is the ultimate pivot versus persevere dilemma. Most founders hold on to their legacy products far too long out of ego or fear of revenue loss. I have watched companies slowly bleed to death because they refused to kill the product that originally made them famous. Musk killing the S and X is the most rational, cold-blooded engineering decision possible. You do not optimize a depreciating asset. You delete it and reallocate the processing power to the next major node. But the liquidity trap he is setting with the SpaceX IPO is the maneuver that will be studied in business schools for the next century. By demanding a 30% retail allocation, he is fundamentally altering the power dynamics of public markets. He is stripping the pricing power away from the Wall Street syndicate desks and handing it to a decentralized, highly loyal retail base. This base will happily absorb the massive valuation multiple, not because they ran a discounted cash flow analysis, but because they are buying a ticket to a galactic civilization. It is a masterstroke in stock-based compensation and the ultimate set of golden handcuffs. By floating SpaceX, he creates a liquid currency to retain the absolute best engineering talent in the world. You cannot hire a top-tier AI researcher away from Google or OpenAI with a cash salary anymore. You need the upside of a pre-IPO equity grant in a company that is actively trying to colonize Mars and build an artificial brain. The retail investors provide the liquidity that makes those employee equity grants valuable, while the sheer size of the offering starves his competitors of the capital they need to catch up. However, the fragility of this system cannot be overstated. When you build a $1.75 trillion pascals per F fortress, the foundations must be perfectly aligned. If the retail market suddenly faces a severe macroeconomic downturn, inflation spikes again, and interest rates hike past historical norms, the liquidity that Musk relies on could evaporate overnight. The hodlers might be forced to liquidate their shares just to cover their own personal cost of living. If that retail floor collapses, the institutional short sellers will descend on SpaceX with a ferocity we have never seen. We are watching the greatest high-wire act in the history of capitalism. The Model S had to die so that the robots could live. The robots need the silicon from Terafab. Terafab needs the capital from the SpaceX IPO. And the IPO needs the retail investors to blindly trust the math. It is a beautiful, terrifying, perfectly engineered machine. And whether it results in the next evolution of human infrastructure, or the most spectacular financial collapse since the dot-com bubble, one thing is absolutely certain. The rules of the game have permanently changed. I am Alex, and I will see you in the next breakdown.